$7 trillion. That's how much money moves through one single global market every single day. It's a financial system on a scale that is frankly almost impossible to wrap your head around, and it operates silently, completely in the background of our daily lives.
You see, this system underpins just about everything in the modern world. It affects the price you pay for imported goods, the value of international investments, and even the cash you exchange when you go on vacation. In a very real way, it's the fundamental plumbing of the entire global economy.
Here at TRADEVERSE, we unpack the hidden systems that run our world, and today we're opening up the machinery behind the largest financial market on Earth, the foreign exchange market, more commonly known as Forex.
To really get a handle on this, we have to start with a very basic question. Why? Why does a market this huge even need to exist? Well, the answer is surprisingly straightforward. It all comes down to the basic mechanics of global commerce.
Think about it. Anytime goods, services, or capital cross a national border, a currency conversion has to happen. Let's make it real. Imagine a country needs to import oil. Now, oil is almost always priced in US dollars. So to buy that oil, the country first has to sell its own currency and buy US dollars. Now just picture that single transaction and multiply it by millions of others happening every single hour, all across the globe. That is the constant demand that fuels the Forex market.
So you can see, it's really the hidden engine of global commerce. And to understand how this engine actually works, we first have to learn its language. You see, currencies are never traded in isolation. The entire market operates on a system of relative value, a language that is built on pairs.
Everything in Forex is quoted and traded in pairs. The first currency listed is called the base currency, and the second is the quote currency. So, if you see the Euro/USD pair is priced at 1.1000, it's actually pretty simple. It just means 1 euro is worth exactly 1.10 US dollars. And the price of this pair, it's always moving, constantly shifting, reflecting the economic tug-of-war between those two nations.
Now, this dynamic creates a really unique trading environment. Unlike in many other markets, you can speculate on a currency's value going up or down. A trader can buy a pair, betting the base currency will get stronger, or they can sell a pair, betting it's going to get weaker. This means profit is possible in either direction, provided, of course, your speculation is correct.
So you've got this massive market, right? Absolutely dominated by huge international banks. It sounds completely inaccessible to the average person. So how is it that millions of individuals, what we call retail traders, are able to participate every single day? Well, it's all thanks to one single, incredibly powerful, and often deeply misunderstood financial tool.
That tool is called leverage. And at its core, it's a pretty simple idea. A broker essentially provides you with a short-term loan that multiplies your own capital. Now, these ratios can vary a lot, and they're often subject to strict financial regulation, but their purpose is always the same: to allow you to control a much larger position than your own funds would normally permit. And the effect of this can be, well, pretty dramatic. Let's take a common leverage ratio, something like 1 to 100. If you have just $1,000 of your own capital, that leverage allows you to command a position worth $100,000 in the market. This mechanism magnifies the potential for profit from even the smallest price movements.
But, and this is the most important part, that amplification works both ways. Leverage is a classic double-edged sword, because just as it magnifies your potential gains, it magnifies your potential losses with the exact same unforgiving force. And this is the critical turning point. It's where immense risk enters the picture and where the story for most retail traders begins to change.
To really understand that risk, we have to zoom out. We need to look beyond the individual and see who truly controls this ocean of capital. Because at its heart, the Forex market is, and always has been, a game of giants. The overwhelming majority of that $7 trillion traded daily is moved by the major banks, the huge financial institutions, central banks, and large corporations. They control the liquidity, they drive the primary trends. Retail traders, those individuals using leverage, they represent just a tiny sliver of the total market volume. They are participants, yes, but they do not control the game.
And this reality leads to a very sobering statistical truth for those who try to navigate this complex environment without a deep understanding of how it's all structured.
It's estimated that approximately 90% of aspiring retail traders fail. They lose their initial capital. And this is not a matter of chance or bad luck. It is a predictable outcome of systemic factors. The reasons are incredibly consistent. It's the misuse of leverage, turning that powerful tool into a mechanism for self-destruction. It's the absence of a strict risk management strategy, a discipline the institutional giants never neglect. And it's making decisions driven by emotion rather than by disciplined analysis. Success in this arena isn't about predicting the future. It's about managing probability like a professional. The Forex market is not a path to easy wealth. It is a core component of the global economic machine, a complex system governed by powerful forces. For those who operate within it, speculation is secondary. In this global machine, the most valuable asset, the ultimate currency, is a profound understanding and a deep respect for risk.